Honorable Dean of Faculty of Economic and Business, Diponegoro University, Professor Dr. Suharnomo, SA, MSc, Professor George Iatridis, University of Thessaloniki, Greece, the head of doctoral program in economic, the Faculty of Economic and Business, Diponegoro University, the Secretary of Doctoral Program in Economic, the Faculty of Economic and Business, Diponegoro University, Bapak Fuad Set, MSc, PhD, as the moderator of the event today, respected audience, undergraduate and postgraduate students, ladies and gentlemen. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam.
First of all, let's praise our God, Allah Subhanahu wa Ta'ala, the most gracious, the most merciful, the creator and sustainer of the universe, so we can all attend and participate in this online event without any obstacle. Today, November 9, 2021, we proudly present guest lecture with the theme of corporate philanthropy, pessimism, and accounting quality. As the first agenda of today's event, I would like to invite the Dean of Faculty of Economic and Business, Universitas Diponegoro, for an opening speech. To Professor Dr. Suharnomo, SA, MSc, time is yours.
Terima kasih, Mbak Lina. Assalamualaikum warahmatullahi wabarakatuh. Salam sejahtera untuk kita semua. Good morning, Prof. Iatridis. Good afternoon, ladies and gentlemen. It is a great pleasure for me to deliver the opening remark for our international guest lecture series organized by Doctoral Program in Economic, Universitas Diponegoro. First of all, before we begin our guest lecture, I would like to express my heartfelt gratitude to Prof. Emmanuel Iatridis and to all of you who sincerely committed to this event to make it a success. This event would have been impossible without the support of each and everyone present here. Thanks, Mas Prof. Anis Karire and team who organized this event very well. Ladies and gentlemen, Professor Iatridis is a prominent, distinguished professor in accounting from University of Thessaloniki, Greece. His intellectual works have been cited by a lot of accounting scholars around the world. And today, he will share this experience and expertise concerning issues on corporate philanthropy, pessimism, and accounting quality. This is an interesting topic as all companies may involve in these issues. Ladies and gentlemen, corporate philanthropy and narrative disclosure are two topics that have attracted business and accounting scholars. Corporate philanthropy may be expressed as cash donation given to charities directly by the company or indirectly through a company-sponsored foundation. Corporate giving can be considered as the form of corporate social behavior. It is not just about maximizing company profit or improving certain financial figures, but it is about improving a company's social profile and picture. Thus, it is maybe viewed positively by investors, market authorities, customers, and the local communities. Corporate philanthropy may be motivated by some motive, such as reinforce their bottom line, to show social responsibility, or legitimacy reason to reinforce the CEO's profile, and due to the other reasons, such as political cost, lobbying, religion, and altruism. However, to some extent, corporate philanthropy may be also used by opportunistic agents as a medium for manipulating income that eventually decreased accounting quality. Another issue may affect accounting quality is narrative disclosure. Narrative disclosure should critically explain managerial assumption, estimation, estimate, judgment, and sources of estimation uncertainty in order to shed light upon the accounting and financial policies that are implemented. Numerical disclosure should quantify the narrative disclosure reported in a transparent and verifiable manner that provide forward-looking information in order to allow investors to make informed and unbiased investment decisions. However, in practice, narrative disclosure may create a greater room for manipulation than numerical disclosure by utilizing the use of optimistic and pessimistic language and of the respective tone changed in reporting narrative disclosure in the annual report. Ladies and gentlemen, hence it is interesting to see how corporate philanthropy, the use of language, especially pessimistic one, and accounting quality may relate to each other. Thank you very much. Fortunately, today we have Professor Iatridis to talk about these issues. Ladies and gentlemen, I believe this guest lecture will be profitable and fruitful for everyone present here and will give us a lot of insight about the opportunities for doing research in corporate philanthropy, the use of optimistic and pessimistic language, and accounting quality. As well as I know the participants of this event consist of doctoral students, some master and undergraduate students, and also faculty member and our alumni. Some participants also come from other universities. Finally, I hope you all enjoy this international guest lecture. Again, thank you very much, Professor Iatridis, for sharing experience. Thank you, Dr. Fuad, for your role as a moderator. Thank you all participants and enjoy this guest lecture. Thank you. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. Thank you very much, Professor Dr. Suharnomo, SAMSE. Excellencies, ladies and gentlemen, move to the following agenda. We have come to the main part, the reason we are here for, the guest lecture with Professor George Iatridis that will be opened and moderated by Bapak Fuad Set, MSc, PhD. We cordially invite Bapak Fuad Set, MSc, PhD to open and read brief CV of the keynote speaker. To Bapak Fuad Set, MSc, PhD, time is yours.
Right, thank you very much, Lina. Hi, Prof. Hello, Pak Dekan.
Hey, how are you?
Oh, very good, thank you.
Yeah, this is
Prof. Anis.
Another room.
Right, yes, we are still in the campus. How are you, Prof? Iatridis? How are you, Josh?
Very well, thank you. I'm ready to start whenever you are. You say.
All right. Okay, hi everyone. It is my pleasure to welcome you all here on the virtual 2021 PDEA International Guest Lecture Series. We call it Accounting Forum, which is organized because this the topic is on accounting, which is organized by Doctoral Program in Economics, Faculty of Economics and Business, University of Diponegoro. And today we are very fortunate to have a very distinguished speaker for this event, Prof. Iatridis from University of Thessaloniki, Greece, and he is one of the most, of course, you all know that one of the most respected professors in financial accounting, and his research work stems from the accounting disclosure, accounting standards, earnings management, and so on and so forth. And just let me read a little bit on his CV. And Prof. Iatridis was awarded PhD in Accounting and Economics from Universities of Southampton. Am I right? And two of our lecturers were the alumni of University of Southampton. Yes, right.
The master's from Southampton,
and
the PhD
then,
from Manchester.
Oh, okay. Master from Southampton. And then Prof. Iatridis is currently an associate editor of Emerging Market Review and also the Internal Review of Financial Analysis. And also he is the adjunct professor of Hellenic Open University. And today, Prof. Iatridis, Josh, will be discussing two of his papers, corporate philanthropy in the US stock market, evidence on corporate governance, value relevance, and earnings manipulation. Another is also interesting topic, which was published in International Review of Financial Analysis, financial reporting language in financial statements. Does pessimism restrict the potential for managerial opportunisms? Okay, without further ado, Josh, you may start now. Thank you very much.
Dr. Fuad, thank you very much for your kind invitation. Let me start by asking, do you hear me well? Do you hear me well? Yes? Okay, thank you.
Yes.
I'd like also to thank Professor Suharnomo for his introduction. Many thanks. And I'd like also to thank everybody for your participation and for your kind appreciation of my work. I'd like to start by saying that I'm not one of the prominent professors. I'm just trying my best to, actually my humble, contribution, which I think I have a lot of, still a lot of way still to go. But thank you so much for your kind invitation. It's an honor for me. Thank you. I'd like to start by saying, well, actually, let me share the screen. Yep. Oh, I think, Dr. Fuad, you should actually allow me to share my screen.
Yes, yes, we are going to assign you as co-host. Yes, please wait. Mbak Lina?
I think if you go to my photo, to my video box, there are three dots at the upper.
All right, we are still assigning you as the co-host. Mbak Lina, because I'm not the host.
Ampun Pak Fuad.
Okay.
Sudah.
All right, Prof. You are the co-host now, so you may share screen.
Okay. All right, I'd like to first start by saying the motivation for writing this paper. I think it was quite interesting. Once I actually watched the video, there was a round table of many rich people, including Bill Gates, Warren Buffett, and many other top 10 rich people in the world at that time. And they were talking about corporate philanthropy, about philanthropy in general. And to my great surprise, for some time, I actually closed my eyes, and I was just listening to what they were saying, and I thought that I was basically transferred to the church. It could be the same as if you could listen to priests talking about philanthropy, about giving, about being merciful, and about helping people. And I was very much, very positively impressed, because I could hear basically people who were very rich and that I would expect that they would be talking about money and how to accumulate more and more wealth, and just that. But they were talking instead about how to give and the meaning of giving, and in this life and of course in afterlife as well. So I said that if these people are talking about giving, then we all should, from our own perspective, of course, and point of view, try to talk about giving and highlight the merits of giving, so that we can basically persuade more people in giving anything that they can, of course, and in any possible means that they can. So this is how this paper was basically born. So let me start with the introduction. I'd like, first of all, to say how we distinguish corporate philanthropy. Corporate philanthropy. Philanthropy is a Greek word, an ancient Greek word. It consists of two parts. Phil or philos means friend. Anthropos is man or woman, man. So philanthropy means one being friend to fellow humans. So corporate philanthropy is distinguished in cash donations given to charities directly by the company or to other causes, of course. Second, indirectly through a company-sponsored foundation and or as in-kind gifts of a company's products, services, infrastructure, or know-how, which of course does not take the form of cash. And I should say at this point that the literature, and I think practice as well, are in much favor of in-kind gifts, of in-kind contributions, as we also call them, because there is this fear sometimes that when you give cash, it may be that the people that are in charge of managing that organization, for example, may be misusing or mismanaging your cash, your money. So many people in many companies are in favor of in-kind contributions. Although I must say that whether we give cash or whether our cash is misused or mismanaged or not, as far as we are concerned, the good deed is of course performed one way or another. But of course, we would like, our cash, our money, our contributions to be well and honestly utilized, of course, for the good of people. Anyway, now I actually used as a database the giving. There's a database called the Corporate Giving in the US, Corporate Giving Directory in the USA. And in 2011, this paper is a few years old, of course. I found that 73% of charitable giving came from individuals, which is, of course, something that one would be a bit surprised at, because one would expect that companies would do the main job, the main giving job. 14% came from foundations, 8% from bequests, and 5% from corporations. The majority of charitable dollars went to religion, education, 32% and 13% respectively, and human services, 12%. It is, of course, admirable when we see people, rich people, like, for example, Bill Gates, having donated half of their fortune, or Warren Buffett, likewise, or other people that are inspired by these acts and decisions and follow, of course. So here we can see a table that shows corporate giving. We're talking about corporations now, in 2012. And here we can see the top 10 givers. We can see that the majority, of course, of this is in cash, but also we have a few examples in in-kind contributions. So, a bit of more of the background and introduction. Corporate philanthropy is significantly explained by the stakeholder theory. So the underlying theory of my work has been the stakeholder theory. And at this point, I would like to say, since, as Dr. Fuad said earlier, we are also watched by doctoral students, I would like to say that it's very important that whenever we write a paper, we must identify the financial accounting theory or the theoretical framework in general first. And without it, we cannot actually move at all. Therefore, it is very important to have a theory first, and based on that theory, to extract the variables that we will be using in our models, and also to use this theory as a main vehicle for explaining and for testing our hypothesis as well. So, yes, the stakeholder theory is or was my theoretical framework for this paper. In the sense that it is a way for companies to display their social responsibility to the local community to satisfy stakeholders' interests. The stakeholders, of course, are not only shareholders or lenders, but there are any other parties that may be interested in our whereabouts, in our decisions, acts, and of course, in our reported accounting numbers. This study is more specifically based on agency theory, which suggests that managers gain through corporate giving, and on value enhancement theory, which argues that corporate philanthropy increases shareholders' wealth. So you see here in the second bullet that I have also tried to be a bit more precise. You see, the paper talks also about earnings manipulation, earnings quality. So whenever I believe we talk about earnings quality, or if you like, earnings manipulation and earnings conservatism, earnings quality in general, I think that we cannot forget or avoid discussing about managers' true intentions when they prepare accounting statements, or even worse, allow me to say, when they choose their accounting policies. So we know very well that accounting policy choice impacts on equity valuation significantly. I think this link must always be in our mind. So once again, accounting policy choice and equity valuation. So I thought that it would be very important and very useful, of course, to also use the agency theory, which discusses the behavior of managers and their relationship with shareholders, lenders, auditors, and other key stakeholders as well. And with respect to value enhancement theory, as you see at the bottom of this bullet, it talks about how a company's policy or decision may affect shareholders' interests and shareholders' wealth. So the decision to give more or less, or the decision why to give or not to give anyway, of course, is going to signal, to give a good or a bad signal to the market about our prospects, about our personality as a company, of course, as well. We know that many people say, many individuals, many people say that, oh, they give because they want to get some tax credits, some tax benefits, or some tax shields, or they want to give because they want to, as we say, throw dust on people's eyes and mislead them, or just show a good face anyway. But my point of view is that although this may happen, of course, it may happen to some extent. Of course, we cannot rule this out. Nevertheless, the question is: do they do good? Are certain parties of people, do they benefit or not? The main motive to finance philanthropic causes in the effort to enhance a company's social responsibility profile may be regarded as an agency cost, since the act of good by managers may create opportunity losses for shareholders. So this is exactly what I highlighted 1 second ago. Not only with respect to the real and true motives behind corporate giving or corporate philanthropy. So it's not only the true intentions behind the specific decisions that may, of course, be questioned by shareholders primarily and other stakeholders, of course, but it's also the size. You see, how much we give may, of course, negatively impact on future cash flows or future earnings that we may have available for alternative uses for our company's, of course, welfare and future prospects. Therefore, there should be a balance between what we give and how much we give. Although there is written that people that basically, or companies that basically give and donate, it is as if they actually lend to God Himself, meaning that it is so a divine act, basically, that is, of course, highly appreciated by God Himself. So, decisions and behaviors like this may be questioned, especially if corporate spending is related to self-defined giving programs. So we see that in this particular case, we actually follow a different direction, different avenue, which is not the idealistic one that one would otherwise expect. Previous research on corporate philanthropy has concentrated on the association between corporate giving and taxes, company earnings, government incentives, and market conditions, basically. So this is, at that time at least, the first study, or this was the first study at that time, to link corporate giving to earnings manipulation, corporate governance, and value relevance. So in this particular slide, I tried basically to show in general what has been studied and what is the main contribution of this paper. Attributes of corporate giving. Okay. High leverage and strict debt covenants are likely to reduce corporate giving. Higher debt would signify that lenders exercise greater monitoring and corporate giving would be more credible. This may or may not, of course, affect corporate giving negatively because of this greater monitoring. But I believe that if one would like to give to a really honest and worthwhile causes, then I wouldn't imagine that the leverage or the governance monitoring would basically lower this corporate giving amount. Of course, if managers would like to give or to direct giving, corporate giving, to self-defined causes and objectives, then this, of course, would be facing certain problems and limitations, which would be good, of course. High growth would show that companies possess certain competitive advantages. When I say high growth, I mean firms that experience or that display high or higher growth rates. So high growth would show that companies possess certain competitive advantages which may lead to positive market values and stock returns and encourage them to give to charity even more, or use excessive cash for their growth potential. Well, I would like to take advantage of this bullet and basically say that when a firm is growing, when a firm is growing fast, when a firm is visible in the marketplace, in the market arena, I think that if they gave significant amounts of cash, or if they contributed in any other kind or way, of course, then I believe that this would give a very positive signal to the market, and this would then tend to attract more capital or easier funds in any way in the future. But as I said previously, although I don't like saying this because I wouldn't like someone to do a good deed just because of materialistic or just for materialistic objectives and purposes, it would be good to keep the idealistic, of course, and divine objective, which is, of course, in giving. Companies with more and diverse sources of revenue would possess a more stable income stream, which would reinforce their corporate giving in the long run, or which would stabilize their corporate giving contributions in the long run. Large and highly visible companies may be inclined, as we discussed a few seconds ago, to give back to the community in the form of public donations in order to obtain a favorable treatment from market participants and authorities. It is basically, in a single word, the signaling effect of giving. Similar considerations would hold for companies that operate in environmentally sensitive industries. We understand that this is the case, I think, globally, like chemicals, plastics, oil and gas, as well as for companies that are in highly regulated industries, such as banks and financial services. Now, I think that this last bullet may be a bit controversial. I think so. In my country, in Greece, for example, there are certain industries which do not respect environment, unfortunately, and it has been observed and witnessed and documented clearly, of course, beyond any doubt, that especially these specific companies tend to give more to the city or to the government in an effort to, of course, make their or transform their public image and make it a bit more positive. But there are some cases where the city or the church or the government do not accept their donations. just because they understand that they do this just to, of course, make their image more positive. So you either respect the environment and respect society, or not. So by just giving some of money or scholarships to students does not, of course, make you innocent of the disrespect to the environment and to the society, of course, subsequently. We know, and this is my last remark with respect to the previous bullet, we know that places, unfortunately, where environment is not respected by industries, do so, I repeat the word unfortunately, higher rates of cancer. And my university also has a medical department, a medical school, and this is what they have also documented in the local greater area, of course, unfortunately. Corporate giving would tend to be positively related to both sides. So now we link corporate giving with corporate governance. Boards with more independent and outside directors. Of course, we understand that boards that have more independent and outside directors are to a larger extent monitored, or more closely and more effectively monitored. So they would tend to apply more intensive oversight, yes, with respect to what is donated, what is given, and to what specific causes. Companies that display higher levels of internationalization would also tend to exhibit greater corporate giving, because I believe that they would tend to be more sensitive to issues and to that refer to society and to such causes. Also, companies with more years of operation are more likely to support charitable causes as well. And now a few only remarks with respect to the theoretical framework of this paper before we start talking about the methodology. Corporate giving is discretionary and would also fluctuate with the level of discretionary accrual. It is also documented that firms may also resort to earnings manipulation to beautify their numbers and also so that they give more. So firms would tend to do anything in their powers, anything possible in their powers to influence their public image positively, and they would tend to use every possible frontier, every possible way to achieve this. Free cash flows may be used to interpret the behavior of discretionary accruals. Managers may act opportunistically by using shareholder money or giving to targeted beneficiaries at their own discretion. So you see, this is where agency theory comes into. Absolutely. I think that the second main bullet here, the second gray bullet, says everything with respect to why we need the agency theory in our effort to describe and capture managers' behavior in this respect. So corporate giving may be regarded as a form of social exchange or discretionary reserve for managers and their reputation and their public image as well. Managers could select to donate in-kind gifts which are of lesser operational value or which entail relatively less significant outflows for the firm. For example, tangible fixed assets that are close to the end of their useful economic life or obsolete inventory. Now, I would not like to be misunderstood. I'm not, of course, saying that this is what firms should be giving or people should be giving. Basically, we should give the best we can, right? Or the best we have, of course. This is what we should be sharing with people. No question about that. But if a firm has an asset that still has some value or residual value, then of course they may donate this, of course, under the condition that is and will be of good value for the recipients. Also, low-cost goods or services to socially sensitive groups of people may be given for free. And now let us go to the heart of this presentation and of this paper, of course, of this research. So this paper has examined 687 US firms listed on the New York Exchange. You can see right below that the initial sample was 2,152 firms, non-financial firms. If you ask me now why and how the sample size has gone down to 687 firms, I would say that based on the data availability that I had at that time, and trying, of course, to match my data across various databases that I was using. You can see them right below at the bottom of this slide. Of course, my sample decreased to 687 firms. So to be more precise, I got charitable giving data from corporate giving directory, which I also referred to at the start of this presentation. Giving USA, a national directory of corporate giving. So this was my main sources for these were my main sources for giving. I got all my financial and accounting data from DataStream, and corporate governance data from Bordex and the Securities and Exchange Commission filing, and also my financial analyst data from Thomson One Banker. So, with your permission, let me start with my hypothesis. Now, for brevity and to avoid actually making you dizzy by giving so much information, what I suggest is this. Of course, you have the paper in front of you. So what I suggest is, let me basically take you through the main variables, the ones that have been significantly positive or negative, statistically significant, by showing you the results. And of course, whenever I discuss a variable, I will be explaining what this variable stands for. So let me just read out my first hypothesis. Corporate giving is likely to display a positive association with in-kind contributions, size, liquidity, R&D expenditure, and the possibility of litigation, and a negative association with leverage, agency costs, growth, and corporate governance. So if you ask me about the main mission of this first hypothesis, it's basically, well, you see that it's quite exploratory. You understand it's quite exploratory. And the main aim basically was to identify the main characteristics of my sample, of my firms that were giving out to other parties, of course. So here is the table of results, table 3 in the paper. Of course, we should not forget that the corporate giving is the dependent variable. So we can understand here. Let me also, if you want to check the paper, this is page number. This is page number 116. 116 is the page which shows hypothesis 1, the model, and the variables. So we see that corporate giving, of course, as expected, is positively related to philanthropy, to corporate philanthropy. By corporate philanthropy, I mean, I have a dummy variable, which takes 1 for firms that adopt structured philanthropic initiatives. How have I determined this variable? Well, as I said previously, using the corporate giving directory, corporate giving USA, and all these sources for corporate giving. So this was basically my, well, how actually I created this variable. Philanthropy, which is the second variable, is again another, sorry, INC, stands for in-kind contributions. Then the next variable, INC, is for the in-kind contributions, non-cash, but this takes the form of kind. So they give products, they provide services, but not cash. So this is basically a firm's in-kind contributions as a proportion to total corporate giving. I repeat, it is in-kind contributions as a proportion to total corporate giving. And the last giving variable is FRE, the third variable. The next variables, I believe, are easy to follow by their name. They're more common. So FRE stands for the fundraising expenses. Of course, it is the natural logarithm of fundraising expenses. Okay, so allow me to briefly repeat. We have the philanthropy, which is a dummy variable, one for firms that adopt structured philanthropic initiatives and zero otherwise. INC stands for in-kind contributions, and FRE is for fundraising expenses. The dependent variable, which is the corporate giving variable, the main variable of the study, is just the annual corporate giving scaled by total assets. So we observe that these main variables, these are the main variables of this model, display a positive sign. The coefficients are significantly positive and they carry a positive sign, as we would, of course, expect anyway. Yes. Now, we also observe that firms that give are more profitable. They have a higher return on assets. They also display lower leverage, so lower monitoring. That is perhaps why they can give out more. Also, we should say that high leverage may also mean that we have more restrictive debt covenants, which may also limit our ability to give. Also, higher leverage may mean that we also have more guarantees, set aside for the lenders. Therefore, we cannot give more anyway. Also, we observe that givers are larger firms. LNA is a natural logarithm of assets, larger firms. We observe that givers also show TQ stands for Tobin's Q, which is a proxy for agency costs. So we see that the givers display lower agency costs. Let me just take you to the most important variables. We observe that firms that are givers tend to show higher research and development, or they show stronger corporate governance. For example, IND at the bottom of the table is basically the proportion of independent directors. Sorry, not IND. IDB, yeah, IDB, independent directors sitting on the board of directors. I repeat, IDB at the bottom of the table. This variable is negative, which means that a firm that has a lower number of independent directors gives more. Now, again, this variable is debatable because you may argue that if they want to give to really worthwhile causes, then why would independent directors raise any objections to this? Yeah, this is, of course, for further examination. Absolutely. Also, we observe that firms that are audited by a Big Four auditor, this is on the other side of the table, also tend to give less. Perhaps I should say that they tend to give less in general, but perhaps they give more in terms of quality. The same, of course, applies if we look at the NEXSEC variable at the top of this table. NEXSEC stands for the non-executive directors proportion to total executive directors. So just to cut a long story short, I should say that variables that are that proxy for corporate governance tend to show a negative association with corporate giving. But as I said a few moments ago, this must be further examined because what kind of giving would that be? Are we talking about quality giving? So you see, now we have to dig a lot deeper. Do we talk about corporate quality, corporate giving, or just general corporate giving. As I said previously, I would not imagine that auditors or the directors, independent or non-executive directors would basically object to any good causes, given, of course, the current circumstances of the company. Now, going to the bottom of this table, yes, okay. We also observe that we have a few more significant variables, NA, SO, and CLS. NA stands for stability and is net assets scaled by total revenue. SO is the proportion of ordinary shares held by shareholders who own 5% or more of the company. So we observe here that a stable firm, a firm that has a large balance of net assets over total revenues, tends to give more. Okay, so they're more stable, as we said previously, so they can also structure a more stable giving. Now, with respect to CLS, which is again a variable that shows greater block holdings in that respect, we observe that firms that are held by only a few or a small number of block holders tend to give less. And also we observe that lit, which is the litigation costs, or the probability for litigation costs, shows a positive association with corporate giving. Now, this is explained how. The literature says that, especially in the US, it is very likely that, or it may be likely, that firms that face serious litigation costs tend to give more in order to favorably impact or influence or impress the jury or the judge in their favor. So this is why we observe a positive association between litigation costs and corporate giving. So these were basically the main attributes of corporate giving, but now the next hypothesis try to be a bit more specific. So the second one is about value relevance. And it goes on like this. Corporate giving is value relevant and is likely to positively influence investor perceptions and future profitability and growth, of course. Now, to test this hypothesis, I used 3 models based on the literature, which follow, of course. The first one has the stock price at the end of the year as a dependent variable. The second one has the market to book value of equity. And the third one has corporate giving. So now you may go to page 117. Um, 16 is the hypothesis, 17 you can see the models. Okay. Let us now start with the first one. Allow me to remind you that the first model had the stock price as a dependent variable. So here, what we observe basically is that if for example, you go down to CG, corporate giving, and philanthropy, Phil, you will see that they both are significantly positive, meaning that they affect the stock price of the firm positively, of course. The same applies with the cash flow, the 1-year scaled cash flow, and also with the cash flow times corporate giving. This means what exactly? If you look at the interaction variable, this shows that firms which give enjoy a positive association between cash flows and stock prices. Now, what is the real center and focus of this variable? we would expect that firms that give so lower cash flows. Lower cash flows might have negatively influenced our stock price because of perhaps poorer prospects in the future. Now, exactly this is what is examined by this specific interaction term. Although we give out more, although of course our cash flows become lower, of course, since we give more, the stock price is not negatively affected because of this good cause, of course. Of course, you may now ask me, how do you know, George, that this good cause is really good cause? How do you know that this specific philanthropic initiative is not self-defined by managers? Okay, that is what may be examined in the future. But this is not easy to examine, though, because one has to identify or distinguish between quality philanthropic causes and high quality and low quality, or self-defined or opportunistically defined by managers. Now, this is not easy, of course, to define, right? Not easy at all. The second interaction term is the cash flow times the philanthropy variable, which of course is another proxy for giving, right? Therefore, we would expect the same sign, positive sign. And this is what we also got as a further validation of the main findings of the specific table. Okay. Right. Now, if you look now at the second panel, panel B, now you remember that the dependent variable here was the market to book value of equity. You may say that this is an effort to carry out sensitivity analysis and see to what extent the results might differ if we use a different variable on the left-hand side of the model, but we observe the same stuff. So if you allow me to start with the two last interaction terms. Allow me to start with the two last interaction terms: cash flow times corporate giving and cash flow times philanthropy. You see that we have exactly the same sign, which is what I would, of course, I would be very happy, of course, to obtain. So there is a consistency between the two sets of results. Now, with respect to the two first interaction terms, what you see is EAR over BV. Now, if you go to page 117, and at the bottom of this page, on the left-hand side of the page, you will see that this is EAR stands for earnings, net income before extraordinary items over the book value of equity. So it's a profit figure, in other words. So whether, previously we said that whether we give out more or not, actually, no. Although we give out more, I should better say, our cash flows are not negatively affected. I mean, overall, or their association with the stock price, and here with the market value of equity and book value of equity. Likewise, if we give out more, our profits are not impact negatively on our market value. You see that the sign is positive between both interaction terms, earnings to book value times corporate giving and or philanthropy, with market value to book value of equity. So this is very good, of course, because this encourages firms to give out more, because they will know that in an efficient market, this extensive or greater corporate giving will not affect their market evaluation negatively, in few words. And the last model, with respect to the second hypothesis. Now, you may find this model on page 117. The dependent variable is corporate giving here. Now, yes, that's right. Now, this model is a bit, I would say, of higher contribution, because if you look at the first variables, you see that they are FE, FD, log FA, AF. Now, what are these variables? These are analyst forecast related variables. So FE stands for forecast error. FD stands for forecast dispersion. AF stands for analyst following. How many analysts follow a firm in log terms, of course. So one can here, one is able basically here to see the relation between corporate giving and variables that basically go beyond the simple and basic company fundamentals, like earnings or cash flows or leverage or growth and so on. So I believe that this table is really worthwhile checking. I mean, honestly, I truly believe this. So if you want, let us go through this trip together, this journey together. So we observe that that corporate giving shows a negative association with forecast error or forecast dispersion. Now, what is the meaning of this? Of course, now this means that firms that give out on charitable causes, philanthropic causes, tend to show a more stable picture, a more stable stream of information to various stakeholders. Therefore, the efforts that are dedicated by analysts or their forecasts. I mean, when I say the efforts dedicated by analysts, I mean in trying to identify information or to understand where this money goes to or why. Their efforts are less, so that their forecasts are more accurate. Again, you may say that this could be a whole paper, right? A separate paper, of course. Absolutely, definitely, yes, definitely. So you see that my effort here was, or my enthusiasm here, was perhaps to cover more different items on a more surface level, as you see. The more I present this now, the more I feel like that every single, I mean, this hypothesis or this table or this model specifically could be, yes, indeed, a different paper associated, of course, with more hypotheses and more models, of course. Also, we observe that firms that give out more are followed by more analysts, which is, of course, very good. Analyst following, when I was doing my PhD at the University of Manchester, analyst following was, you know, the UK is a common law country, and it gives more emphasis on stock markets, right, and equity valuation, absolutely. And they actually tend to associate accounting policy choice with equity valuation and how different policies and choices may affect the equity values and equity, you know, forecasting. So analyst following is, in my opinion, a very important variable because it shows that you have some, you know, relative weight. Yes, that you mean something in the marketplace. That's why it is really worthwhile being followed. You being followed. It's like Instagram or Facebook. Some people, especially singers or actors or models, basically count their relative weight by how many people follow them, and they do, you know, whatever, you know, whatever they can to attract more followers. And I'm sorry to say that many of the ways that they follow, that they use to attract more people, are not, you know, ways or things that one should be proud of, or that should, you know, basically use as role model, especially for younger people. But nevertheless, you know, counting how many people follow you or here analysts follow you is a very important proxy for one's future prospects. So this is very important. Now, if we go down to RO stands for revision optimism. So this is actually number of revisions. How many? I mean, if you look at page 117, you see that this is the difference between upward revisions and downward revisions, scaled, of course, by the number of estimates. So this basically shows, and that's why it is positive. I mean, it's very small variable though, but very small coefficient, sorry, but still nevertheless it is positive. It shows that something good is going on. Analysts revise their estimates upwards for firms that give out more. So giving does have an impact after all. CTV stands for stock liquidity. It's basically the price change in trading volume. So we also see that this carries a positive coefficient. Trading volume, of course, is greater. BA stands for the bid-ask spread. The bid-ask spread stands for, or proxies, for uncertainty. That is why the bid price and the ask price may show a significant deviation between the two from each other. But if uncertainty is lower, then of course the two would coincide or would tend to coincide, and therefore this would form a smaller variable. Or here you see that, of course, the more you give out. Now, again, I don't really like this result, but in general, exactly because I have not distinguished here between, as I said, good quality giving and bad quality giving. It's basically giving in general. So, it may be that some market participants, it may be that some sort of a big group of investors may not feel very, very confident with what exactly you're giving to. That is why we may have a greater deal of certainty. Of course, here you see that it is a negative coefficient, which shows that it is lower in the US setting. So it may be lower in the US setting because we know that in the US, stock market regulation, investor protection mechanisms, corporate governance are stronger. And of course, all these monitoring device mechanisms are there, more or less, of course, more or less. There is not a perfect marketplace nowhere in the world, but all these mechanisms may be in place to lower uncertainty and, of course, make sure that corporate giving is of higher quality. But again, I believe this is to be further examined. Okay. Now, just one more perhaps. If you look at the other column of this table, if you go to JF, JF on page 117 shows it's a Janney-Fadner coefficient. It basically shows the favorability of media coverage. That's why I actually wanted to use this variable. I repeat, it shows the favorability, how favorable media articles, media coverage is with respect to companies that they give out more. So you see that, of course, as we would expect, there is a sort of a favorability towards this firms that give. The media articles are favorable. Okay, hypothesis 3. Now, this is actually this goes into the heart of this research. Hypothesis 3. It directly relates giving with earnings manipulation, with earnings quality, I should better say in general. AA, which is the dependent variable, is the abnormal accrual. It's a proxy for earnings manipulation. Of course, we know that there are many proxies for earnings manipulation. So one may conduct additional models or additional tests using different dependent variables for earnings manipulation. So what we observe here, well, is that earnings manipulation in this specific US setting is lower for firms that give. So you give more, so corporate giving is higher, or philanthropy is higher, or in-kind contributions are higher, and earnings manipulation is lower. So in this particular setting, I repeat, what I found was that firms that give tend to use earnings manipulation to a significantly lower extent. So this also makes me think that that the philanthropic causes that were pursued were of higher quality, and they were not self-defined objectives that were pursued by firms, at least not to a significant extent. But again, as I said many times already, this is to be further examined. If one can, of course, get access to this specific data, distinguishing philanthropic causes into prudent ones and imprudent ones. Now, you can also see that I have a number of Eric's manipulation variables here, like bell, below, high. These are, if you look at page 100 and hold on a second, this is basically 119. You will see that they basically are dummy variables. Like, for example, bell below is 1 if earnings before manipulation is less than 0 or less than lagged reported earnings and 0 otherwise. So I don't want to confuse you or to make you dizzy. You can find this, of course, in my paper and also the papers where I got them from. But what I can say now, just for simplicity reasons and for brevity, is that they are earnings manipulation proxies. So I have created a number of interaction terms like bell below times corporate giving or high times corporate giving. And I have found again that the earnings manipulation extent appears to be lower. Likewise, if you look at the other side of the table, corporate giving times LNA, the first interaction term in the second column, the third term, the third variable, if you like. So if you multiply corporate giving times size, you see that larger firms which give tends to show lower earnings manipulation, negative sign, or firms that have a larger number of non-executives also manipulate less, next sex, or big O, big auditors. Firms that are audited by big four auditor also tend to display less earnings manipulation. Now, what happens if you look at MBV, the fifth variable, the fourth variable. No, apologies, the fourth variable, The fourth variable is CG times, you don't see that here, my mistake here. It was not taken into account in the table, in the formatting. This basically should be leverage. Let me check. Now, this is LNA for size, as you said. Oh, no. Then this is times, should be times cash flow. This is times cash flow. And then we have the MBV. So firms that basically give may tend to use earnings manipulation to lower the negative impact of giving on their cash flows. Likewise, firms that are in a high growth area may tend to, again, manipulate more in order to give out more, in order to attain their targets, especially their growth rate targets, and at the same time show a good picture. Not good, but yeah, that may happen. And finally, if you look at the last variable, firms that basically are held by a small number of blockholders, CLS, tend to manipulate less. Now, conclusion. A new CEO or CFO is more likely to spend on charity in order to influence market participants' perceptions and also improve their public image and reputation. The adoption of in-kind contributions is likely to reduce agency costs. Tobin's Q proxied here, TQ, if you remember. Large firms tend to give more, and high growth firms tend to, or may tend to give less. Or they give more, they may tend to resort to risk manipulation to mitigate the negative impact of giving on their cash flows. High leverage and strong corporate governance tend to monitor the use of slack resources more intensively, meaning that what is given would tend to be given to a higher quality and more carefully, of course, selected philanthropic causes. Corporate giving is positively related to analyst forecast accuracy and may lead to significant analyst coverage and upward revisions, and lower, of course, bid-ask spreads. Corporate giving reduces the scope for earnings manipulation. For example, charity givers with low liquidity and high leverage display lower abnormal accruals, although one would expect the opposite. But we basically make the assumption here that the givers are firms with higher, with greater qualities and values. And that is why we say that they would be less likely to manipulate. Now, having said that, I'm actually at the end of writing a paper on religion. And this is basically what I have also observed, that religion or religious firms tend to display low earnings manipulation and tend to report annual reports that are more conservative. And also, the language of the reporting tends to be more conservative. Now, I did not actually choose to present that paper because it is not yet in a form that is presentable yet. But I would be very happy to do that in the future. Okay. So, a bit of implications. Effective corporate governance would restrain unwelcome manipulative managerial behaviors and would therefore reduce agency costs and strengthen firm value. So accounting regulations should reinforce the quality of disclosure requirements. This is what I'd like you to underline here, the quality of disclosure requirements. With respect to corporate giving in our particular research, of course. So disclosure requirements that relate to fundraising and corporate giving. For example, that one of France's prior presidents has been accused for misreporting fundraising expenses a few years ago, right? Perhaps you have come across this in the news. So fundraising is absolutely very important for political parties, for organizations, for everyone, of course, because it is other people's money that's being directed to these causes. In-kind contributions, as opposed to cash contributions, may be used as a governance or monitoring tool to reduce the scope for earnings manipulation. And some future research. Future research may want to investigate the potential for earnings manipulation that may be applied under different tax settings in order to maintain firms' ability to spend on charity and meet personal managerial objectives. It should also comparatively examine corporate giving in countries with different institutional characteristics, such as common law versus code law countries, or emerging markets, or countries where the quality of financial reporting is not so strong. Now, I'd like to basically say one thing, only one thing about this last point. In countries where the quality of financial reporting is perceived to be lower, while writing this paper on religion, I have read, of course, many papers, and I have basically come to understand that religion can be used as an institution in general, of course, that can be substitute for the lack or absence of effective monitoring and governance and regulatory settings and structures in a country. So in countries where regulation is not so well developed or that is under development, then religion may actually serve this specific purpose, the purpose of honesty and of reporting financial numbers in an honest and truthful manner, and also representing the true and fair economic picture of a company without having, of course, to abide by specific regulation or laws, as long as religion is meaningful in that specific country, which I think is extremely useful and extremely, of course, impressive. Meaning that religion is not just an idea, as unfortunately many people want to think or basically want to convince others, but religion is, of course, not just this, but a way of living and a lot more than that. That is why I'd like to say that I really like how you started today's presentation. You said you asked for God's help and enlightening, so that no obstacles are presented in today's seminar, and that all goes smooth with God's blessing. So I'd like to say that I really like this, and I only wish that this was also in Greece and in other countries as well. So this was my first paper's presentation to you, and this also was your lesson to me. And thank you very much for this. So that's the end of the first paper. I would be very happy to answer your questions. Do you have any questions?
All right. Thank you very much, Prof. Okay. Before we open to the audience, I have a few questions. It's very interesting, and it is a very huge research, Prof. So first thing first is regarding the in-kind contributions, and you also mentioned that some firms do not report the in-kind contributions. And do you see that this will become an issue, that the charitable giving may not reflect the true charitable giving that was supposed to be reported by the firms, and therefore may may result in less accurate findings? Do you see this issue as well, Prof. Iatridis?
Thank you very much, Dr. Fuad, for your question. Your question basically gives rise to what we call verifiability of accounting disclosures. So I believe that corporate giving is a very good topic, a very good pool of information one company to disclose, because it is another way to advertise themselves and to impress people, of course. So every firm would be 1000% eager to discuss and say a lot of things about what they give and what they do. But although this may happen, of course, the true verifiability of information, in other words, the true contribution of what is being disclosed, is questionable and debatable. And I'm sorry to say that although we may come across a lot of information being disclosed, the true meaning of this information, I mean, how this information may actually really help us to make good decisions about this firm's giving or about this firm's honest management or improvement prospects may be, after all, very limited. There is a professor called Peter Pope, a very famous professor in Europe. He's a professor at the London School of Economics and Bocconi University in Milan, Italy. Always told me this: check the verifiability of information. Don't check the quantity of information. Check to what extent this is verifiable. And by verifiability, we mean all this judgment, all these assumptions, all these estimates, all this estimations and information that is being brought forward. To what extent is explained to us? So, as you said, Dr. Fuad, I'm sorry to say that to a large extent, not many real details are being, are being brought forward to people. Therefore, this, although is a topic that they would like to discuss, remains a gray topic, a gray, disclosure area in the annual report of the firm with respect to real contribution.
All right. Now let's say that we are interested to capture the, the charitable contribution or the charitable giving, and that includes the cash giving as well as the in-kind giving as one composite variable. Is it possible to do that, Josh?
To create one composite variable.
Yep.
Consisting of cash givings and in-kind giving.
And in-kind as well. Is it possible? Is
It
it possible to measure? Yeah.
It may be possible, but I would not try it because there are two different things. You see, if we have a firm with a lot of with a greater proportion of non-executives and independent directors on the board of directors, or a company that is highly leveraged and therefore it is monitored by the banks and other lenders, then these parties that I just mentioned, let alone others, of course, may be inclined to promote in-kind contributions in a way to make sure that, first, that managers do not direct these cash flows to their self-defined or preferred philanthropic causes for personal reasons, and second, that the people that manage the specific organizations that manage these funds, or that direct these funds to people that are in need eventually, are not tempted to use your funds in an ill manner. So, in-kind contributions, I believe, should be separately researched and examined from cash contributions, exactly because they attempt to examine a different thing, which is honesty and quality in charitable giving. One, of course, Dr. Fuad may create this composite variable, but again, the weighting factors will be another problem. How then are you going to create this composite variable? But if you do, then you have to carry out a number of sensitivity tests, try different weighting factors, to make sure that this variable does make sense after all.
I see. All right. Thank you. And another follow-up question is a little bit technical.
Sorry, Dr. Fuad. I'm sorry, Dr. Fuad, to interrupt you. If we talk from a paper submission point of view to a journal, right. I think personally, I would be not tempted to do that. I would be reluctant to do this because I might open the door for many criticisms from the reviewer's point of view. So I would perhaps try to keep it simple.
I see. All right. Prof, this is also an interesting equations that you have, and particularly regarding the interaction effects of some of your equations, some of the regression equation. And how did you deal with the multicollinearity issues if you did not split the main effects to test the direct relationships, and then you also have the interaction effects to test the interaction effects? Why didn't you do that, Prof?
I should say that this is not very clearly written in the paper. I think I just said that multicollinearity, heteroscedasticity, autocorrelation have been accounted for without, giving a lot more detail.
I see.
But I should say that in fact, in reality, this is an issue that we all have whenever we start a new paper.
I see.
Before we start with the tests, that is what we basically test: the normality and the quality of the sample. So I should say at this point, Dr. Fuad and dear ladies and gentlemen, that I started, I took my raw sample, first of all, as we all do, and then I created ratios. I avoided using variables in absolute terms. Where I had to, you see that I used the natural logarithm. Then I checked the normality and the quality in general of my sample, and whenever needed, I had to Windsorrize certain variables. I'm talking about the maximum and lower, extreme values of, on either side of the distribution for my variables.
1%, 99%, something like that.
That's right, yes, in Stata. And then doing all this, I had to carry out a number of tests, not only for multicollinearity, and but also for heteroscedasticity and autocorrelation. And I tried to exclude variables that had higher correlation, or let me just say stronger correlation between themselves, and all the usual tests that we basically carry out to clean our sample. That's why you see that my sample is so smaller than the initial non-financial pool of firms listed on the New York Stock Exchange, because of all this cleaning.
I see. All right, thank you.
So it's not clearly mentioned in the paper, but yes, it is accounted for.
I see. All right, thank you, Prof. Now we are going to open to the audience. Many PhD students are here. So please, if you do have some questions, do not hesitate to ask. And any questions will do. Bahasa Indonesia juga boleh. Silakan raise your hand. Ada? Silakan. Perhaps sorry. Silakan. Raise your hand. No? Perhaps they are waiting for another paper, Prof, because the questions may be more generic. Oh, there is from Retno Ika. How to test for indigeneity issues?
Okay, for indigeneity, yes, of course.
Right.
Yes, for indigeneity, what I did basically was the IV models, GMM models. IV, I say IV because there was some probit models, if you noticed somewhere in the paper, and also not for my main models, of course, but for some variables that were in the models, and GMM, of course, for my regressions. Actually, I used leverage as my main variable. That is why you see leverage in most of the models in the paper. And I used basically variables. I had to consult with various professors with respect to this testing. So I thought that I should use either company fundamentals or economic variables. So here I actually used economic variables for my endogeneity tests. So actually, you see the models in the paper itself, but the real model that I had used in Stata was basically having the GMM brackets, leverage, GDP, money supply, and interest rates, and the foreign exchange rates, in my effort basically to capture endogeneity. I know that endogeneity may be captured by company fundamentals, but I thought that if I used company fundamentals, my fear was that it may have been the case that that are manipulated or influenced or beautified by firms. So I wanted basically to get rid of this bias. That is why I actually used independent, variables that firms could not actually influence, just like specifically the economic variables. So that is how I actually tested for endogeneity. I repeat that I used GMM regressions, whereby in the Stata command, I actually used leverage as the key driver against the economic variables. And when I actually tested, when I actually ran the model with this endogeneity inclusion and without, I found out significant differences. So what you see in the models basically is the models that which included endogeneity test. I know that all this should have been mentioned clearly in the paper, and to tell you the truth, it was not raised by any of the reviewers, but this is how they have been executed.
I see. All right. Thank you very much, Prof. Thank you very much, Retno Ika.
Dr. Ika, thank you very much.
Can we? All right. All right. Can we move to the next paper? If you do, if you prepared another paper, right, Jos?
Of course. Yeah.
All right. Please, Prof.
The second paper is on accounting discretion and financial reporting language. The motivation behind this paper is basically the language, the words, the content, and how the content that is made public is influenced by the preparers of the accounts. So the heart of this paper, if you ask me, is basically how the reports are essentially written, the reporting language or the reporting tone of the annual report. Okay. Now let me be a bit more precise about my motivation. Narrative disclosures should present managerial assumptions, estimations, of course, judgments, and sources of estimation as certain, at least in theory. Numerical disclosures should quantify the narrative disclosures reported in a verifiable manner, of course, at least in theory. Managers would be inclined to use more optimistic language for economic gains, at least on average. So the reporting tone is mostly affected by current and future financial performance and stock price related contractual arrangements. When we say contractual arrangements, basically we mean managers' remuneration and debt covenants. The change in the tone leads to excess average stock returns, as long as the market, of course, is efficient. A history of consistently meeting analyst forecasts would motivate companies to maximize their efforts to maintain their good picture. So this means that we would like to maintain this good trend in the future at any cost. So here's the motivation, more specifically. It lies with the prediction that narrative disclosures tend to create greater room for manipulation than numerical disclosures. At the end of the day, the numerical disclosures are audited because they are numbers. Numbers must be confirmed by specific audit evidence, whereas in contrast, narrative disclosures do give some greater leeway for boasting, for example, by certain over-optimistic or overconfident managers. It's less easy, of course, to confirm. It's also motivated by the existence of singular patterns in managing profits, such as reporting small profits, for example, rather than losses, or in meeting analyst targets, which may be facilitated by strategically influencing the reporting tone. So, my sample, well, this study is focused on UK firms. So I basically got the FTSE All-Share Index, firms listed on the London Stock Exchange. Again, you see that the firms is a smaller fraction of the total sample firms, the total firms that are in this index. For the same reason that I explained previously, these are non-financial firms, of course. The period is 2005 to 2013. Why 5? Because this is the year that firms started using IFRS. 2013 was basically around there was basically the date of publication of that paper. The databases are presented right below, and trying to match all my sample companies and data, ended basically, and cleaning, of course, of my data as well, ended to this 405 UK firm for this period. Now, many people question the dependent variable, the tone, the reporting tone, the language tone of the report. When I say reports, I mean annual reports. And I should clarify this because there have been many papers written about the tone of press releases, company press releases, and the tone of media articles. So this paper basically focuses on annual reports tone. It is the proportion of total pessimistic language, i.e. total pessimistic words, divided by the total number of words in the annual report. Now, you may ask, how did I find all this, right? Now, actually, I used what these papers have used, a software called Diction. Diction like dictionary. Diction is the name of the software, which I purchased. And you basically download all the annual reports in PDF form. You plug them into the software, and then you get a number of scores. I think there are a bit 30 or so scores, different linguistic scores about the quality of the language of your plugged in documents, whatever they may be. So there is, of course, the grand score, the composite score that encompasses all the other scores. But you have scores, for example, regarding the forward-lookingness, the optimism or pessimism in isolation, scores that refer to the extent of using words that try to impress investors by boasting, for example, or words that show overconfidence. And therefore, you get this as an independent score, because it's not that you or your fellow colleagues have examined and assessed the language tone, but it's basically, a machine software that has done this for you. I repeat that this software, Diction, has been used by these papers published in the fourth-year journals like Contemporary Accounting Research or Accounting Review. This study has also used two different lists of positive and negative words. Now, you can see them right below. Now, what is the meaning of this second bullet? How does it perhaps link with the first bullet? Now, if you buy Diction, you will see that Diction uses their own lists of words, positive and negative words. Okay. Now, to be more objective, what I also did was basically I used specific indices, Harvard's General Inquirer and Logran and McDonald's. You can also add your own lists of words into Diction. So it's quite a flexible software. And that's what I did basically. So in my results, what you see is basically three sets of, you don't see that basically because for brevity, I reported only one, but in my paper, in my study, I actually had three different sets of results. Okay. So three different sets of results. One following Diction, another one following Harvard, and another one following Logran and McDonald's. And I found out, to my great surprise, and not surprise, but satisfaction, that the results were significantly similar. I did this because one of the reviewers was a bit, and of course he was, or she, I don't know, very right, to question the quality of my dependent variable, the reporting tone. So that's why I actually used all three for further confirmation. Diction, number 5 at the time. Now I think there is 6 or 7. These are some words. I just added them here just for you, for your background understanding. Praise words, satisfaction words, inspiration words. I truly think that this is very interesting, honestly. Yeah. I mean, for my other paper, the religion paper that I referred to earlier, one of the hypotheses is about the reporting language of religious firms. Yes. So you can basically do anything. I mean, in this paper, I actually measure the tone of the whole report. In my religion paper, I have split the report into the narrative section and the numerical section, and I have therefore created two, broad scores. Or you may of course isolate certain items of the narrative section and create a score for them specifically. You can do anything. These are some negative words, blame words, hardship words, denial words used in the list of words in diction. Of course, if you ask me about the Lokran and the McDonald's list of words and Harvard's Inquirer list of words, I will tell you that the good thing is that these papers basically have them in their appendix, so they do show the words more specifically. So the first hypothesis, the proportion of total pessimistic language. Allow me to make a short pause here. The literature says that the tone should be pessimistic rather than optimistic. Just following the conservatism principle. Likewise, here we say that we would expect, we would be happier to find out that the language is more humble, more modest, rather than overconfident, over-optimistic, or boasting. So the proportion of total pessimistic language disclosed in a company's annual report is likely to be higher for companies with lower earnings manipulation. So out of respect for your time, allow me to only highlight the key findings. Okay, so you see here the model. The dependent variable is the tone, once again, number of pessimistic words over the total number of words, over pessimistic plus optimistic, I mean. So we see that, yes, large firms, LNA, or TLSFU stands for leverage, it's a leverage proxy, total liabilities over shareholders' funds. So large firms, firms with high leverage, or firms that are cross-listed on other stock exchanges, or older firms, older firms, tend to show, yes, higher, greater pessimistic language, more pessimistic language. Also, we observe that firms that are audited by Big Four auditor, the same. In contrast, firms that manipulate, Bell and High, again, as in the previous paper, earnings manipulation forecast, earnings manipulation proxies, or firms that have higher abnormal accruals on the top right corner, blue, or have abnormal earnings per share or abnormal cash flows, tend to show lower pessimistic language. The coefficients are, you see, evident of earnings manipulation. So they show lower pessimistic language, as we would, of course, expect. So the first hypothesis is a bit more exploratory. The second hypothesis is basically the heart of the paper, is about the language, the pessimistic language, and earnings conservatism. So here we have a number of models. Again, I'd like to say that all these models are explained more clearly in the paper, together with my sources. Okay, so if we look at these three panels in brief, we will see that the main variable, looking at the panel A, is this three variable interaction, this three-term interaction, tone times CFD times OCF. Now, CFD stands for what? It's a dummy variable. It takes 1 for negative cash flows and 0 otherwise. So we would expect that firms which have negative cash flows to be more prone to earnings manipulation and to be less conservative, of course. So this is basically the main conservatism variable. Now we see that it is positive, which means that firms with a pessimistic language tend to be more conservative. I would like to kindly invite you to read the paper, the specific, let me show you, let me actually tell you. Page 4, yeah, page 4, let me check. Page 4, yes. Page 4 discusses the methodology behind conservatism, how to test conservatism, based on Cano Rodriguez paper published in the European Academy Review. But again, this is the standard procedure with respect to conservatism. Then PD, in the middle, PD stands for the proportion of pessimistic disclosure. So we see that this carries a positive coefficient. If you look at the second model, the dependent variable is the rank UC. UC stands for unconditional conservatism, unconditional conservatism. So what is the meaning of this? If you look at the methodology of the paper, you will see that conservatism is split into good and bad. The good conservatism is called conditional conservatism, and the bad one is called unconditional conservatism. Now, give me 1 minute only to explain this. In the paper, of course, I explain it in more detail. Allow me to explain this especially for our doctoral students, because this is extremely important. Many people think that if you downstate your earnings, say you have meta-analysis forecast, you want to so no more because of tax purposes, or even to store it for future poor economic years. So you think, many people think that if you understate your profits, then you look more conservative and you look more reliable and honest as a firm in the marketplace. Now, this is not true, because it may be that you understate your profits using creative accounting or earnings manipulation exactly to show a good picture in the market, but this is under no conditions. You do this entirely based on your own discretion and opportunistic behavior. In contrast, if you have to say, for example, book an impairment loss, an asset impairment loss, just because your recoverable amount is higher than your book value of the asset, then you have no other choice but to book an impairment loss, not because you want it, but because you have to do it. So this is a conditional conservatism based or conditioned upon the adoption of a specific regulation, say IS 36, International Standard number 36, impairment of assets. So this is good conservatism. Now the rank you see shows is a proxy for the absence of unconditional conservatism. So the PD here, with the proportion of pessimistic disclosures, is positively associated with the absence of unconditional conservatism, meaning that firms that are more pessimistic would show less or lower unconditional conservatism, bad conservatism. So I would like to kindly ask people that are interested in this kind of distinction to look at this paper and at the papers that I also quote for further information, because it is really worthwhile for research, especially when one is interested in agency theory and positive accounting theory. And if we look at the last panel, panel C, you see now that the dependent variable is rank CC. CC stands for conditional conservatism, the good conservatism. So we observe that firms with low unconditional conservatism display higher conditional conservatism. In other words, firms with lower bad conservatism will show higher good conservatism. Also, they will show higher pessimistic disclosures and of course tend to be larger. But if you ask me, I would like to just say that the main variable is panel A, the three term interaction. This shows whether a firm is conservative or not with respect to the tone that they report. The third hypothesis is the proportion of pessimistic language is likely to be higher for corporates with stronger corporate governance. So here you can see a large number of corporate governance proxies, and the tone, of course, as the dependent variable. And that is what we observe here. We see that firms that are pessimistic in their reporting language tend to show greater corporate governance variables. Now, of course, it may be that we may have a composite corporate governance proxy. Yes, I didn't have that in my paper. I actually prefer to use individual corporate governance proxies just to show different, aspects of corporate governance instead of having a composite, an overall one. So this was deliberately done, of course. So, for example, we see that firms with a larger number of independent directors, IDB, or firms, this is all presented on page number 5 and page number 6, the variables, or a firm with an audit committee, AEC, in place, tend to show higher, more pessimistic language. Firms with a larger proportion of ordinary shares held by institutional investors as an external monitoring device also show or are more pessimistic. Firms with more non-executive directors, NED, the same. DUA, DUA stands for the duality concept, whereby the CEO is not the same person or is the same person, it depends on the company, with the chairman, with the president of the company. It would be good to have two different people, of course, for further transparency purposes. That's why you see that duality, which is one dummy variable, one if the CEO and chairman is the same person, shows a negative coefficient, meaning that if we have the same person holding both posts, then the firm may not be so pessimistic, because of course it is easier for the one person to do as he or she pleases, as opposed to where we had two people, of course, monitoring each other. CEOT stands for the CEO tenure. So the longer the tenure is, of course, or the CEO is in office, the less pessimistic, of course, the report may be. And you see that it goes on like this. MC stands for a dummy variable. It is one for when changes in the management have occurred. So when we have a new management in place, the new management would be more eager to adopt a more conservative stance so that they can impress people. SO is the proportion of ordinary shares held by shareholders who own 5% or more, again, by a small set of block holders. And CLS stands for percentage of shares closely held by strategic investors, such as families, trusts, or foundations. You see that in both cases, the coefficient is negative, meaning that the level of pessimism would tend to be lower, exactly because if the investor or shareholder base is not very big, then again, the monitoring will be, or will tend to be, or might be less oppressive. Hypothesis 4A, is about the proportion of pessimistic language and its relation with information asymmetry, and analyst forecast error, and analyst forecast accuracy. And B is again the pessimistic language and its link with the company's meeting or just beating analyst forecast. Allow me to now say that when a firm meets or just beats analyst forecast, maybe that it was a case where they were not, or that they would not be able to meet the forecast, but by using Eric's manipulation, they have been at least marginally been able to meet the forecast or just beat it. That is why I have it here separately. This is another indication of Eric's manipulation, according to the literature. So again, the main finding here, again, what is the dependent variable? The reporting tone. We see that when the reporting tone is pessimistic, then the forecast error is lower. We all understand this, right? Analysts would not trouble that much in identifying the right information in their forecast preparation and in advising their clients. So the forecast error would tend to be smaller and the forecast accuracy greater. The same applies, of course, for the forecast dispersion, FD. These firms would tend to be followed by more analysts, like we said in the previous paper. And also, we see that FAS at the bottom of this table. You can find all this on pages 6 and 7 in the paper. FAS stands for, or PROX is for analyst brokerage size, company size. So bigger firms tend to follow this specific pessimistic reporters to a greater extent. Also, we observe that firms that have beaten analyst forecasts tend to be more pessimistic. Now, behold, when we say beat here, we don't mean marginally beating, but handsomely beating. With respect to the marginal beating, you can see the insig beat on the other column of the table. Insignificant beating. You see, the sign is negative, meaning that firms that have significantly beaten their forecasts tend to show less optimistic language. So the hypothesis for B stands, holds. The same applies for firms that have significantly missed their forecasts or significantly missed their forecasts. Or missed them. Okay. Now, with respect to the yellow variables, S-ball is basically the standard deviation of stock returns, and beta, the beta coefficient of the stock, and BA is again the bid-ask spread. They all carry negative coefficients, meaning that firms that are more pessimistic tend to display lower levels of uncertainty and beta coefficient or variability in their stock returns, which is of course very favorable. And I believe that this should encourage firms to report more pessimistic language. In other words, and to cut the long story short, this basically shows what exactly, dear ladies and gentlemen, it basically shows that if one is humble and modest, he or she will not lose. He or she will still be able to show as a company greater profitability or to enjoy people's appreciation, trust, and confidence. Hypothesis number 5. This is on page 8. This is the last hypothesis of the paper. The change in the tone, the change. So here we don't talk about the pessimistic tone in absolute terms, but the change in the tone. It's likely to affect the cost of equity. So if a company switches from an optimistic, say, or neutral tone to a pessimistic tone, then this is hypothesized to affect the cost of equity positively. In other words, to decrease it. In other words, to decrease it. Then we have the cost of equity on the left-hand side. You can see how it is measured below. Of course, I have to say at this point that we can measure the cost of equity in thousands of ways, right? So many different capital models exist out there. So this is the first one. In fact, I got this model from Easton and Clarkson et al. Published in 4-tier top star journals. So I had no problem with the reviewer because of the quality of the papers and the journals that they had been published in. Okay, so what we see here is table 6. Yes, cost of equity. You see the sign is negative. Firms that carry a pessimistic reporting tone tend to show lower cost of equity because the risk that is involved is lower. Net pos is a variable that basically stands for the frequency count of positive words minus the frequency count of negative words, scaled by the sum of the frequency counts of positive and negative words. Okay, you see, you see that if the positive words are more or more frequently appearing in the annual report, the cost of equity gets higher because the trust gets lower, of course. CT is a dummy variable. It takes 1 when the tone changes. So this is the main variable in this particular table. CT, the change in the tone. See, change T tone. So it takes 1 when the tone changes from optimistic to pessimistic language, and Z and 0 otherwise. You see, it is negative. So when you switch from optimistic tone to a pessimistic tone, the cost of equity tends to go lower. Again, this is a great motive. This result is a great motive for firms to do this switch. Conclusions. So pessimistic language is higher for companies with lower earnings manipulation and higher leverage. High growth firms display less pessimism for obvious reasons. Also, firms with higher pessimism display lower agency costs and higher conservatism. Even, and this is one main result, even if they experience bad news or lower cash flows. I didn't, of course, mention this in the presentation, but it is, of course, documented in the models, in the results, in the paper. They also display stronger corporate governance. Pessimistic language is positively associated with forecast accuracy and analysis coverage. Firms that meet or just beat forecasts use less pessimistic language. They do everything in their powers to meet them, yet to meet the forecast. They don't afford, they cannot afford basically being pessimistic at that point if that is what they want to do. And companies that significantly beat analyst forecasts use more pessimistic language. Finally, the change of the reporting language. This is one of my main results and one of the best results for policy making. Shows that it reduces the cost of equity. Okay, this study adds or attempts to add by examining, have to also be humble, whether companies use language management in annual reports in order to understate bad news, you see, bad conservatism, unconditional conservatism, or to overstate good news. Remember that conservatism is about the asymmetric recognition of gains and losses. We are faster at showing losses and slower at showing profits, according to the conservatism principle. It contributes by showing how the reporting language affects behaviors. For example, companies that just beat analyst forecasts tend to use more optimistic language in order to obtain a better valuation. Or they might use pessimistic language in order to reduce the magnitude of underperformance. Finally, future research might want to investigate the tone of reporting hard and difficult to verify disclosures in the annual report, as opposed to soft disclosures. It may also want to examine the tone of financial releases other than the annual reports, such as annual earnings releases or social networks like tweets. For example, we know that Elon Musk, a few days ago, asked his followers on Twitter as to whether he should sell his 10% of his share in Tesla to pay his taxes. So what is the impact of all this on stock returns and the company's future prospects? That's all. Thank you so much again for your kind attention, and I would be happy to get your questions.
Thank you very much, Josh. Very interesting research. And okay, now I'm going to open to the audience for our second paper. And we have discussed the first paper and the Q&A. But if you do have some follow-up questions, please do not hesitate to ask. Anyone? Please.
Maybe Pak Fuad.
Okay, Prof. Prof. Anis.
Yeah, thank you, Prof. Iatridis, for interesting research. I just wondering to know about some issues. First of all, you said that when you use pessimistic tone, you refers to list of positive and negative word. Is it right? Like price, satisfaction, and so on. So my question is, this is in English, but suppose if I'm doing research in Indonesia, is it possible to apply this list of words in another language? Because if we look at the word you use, we have translation for the word, but it is possible to use the similar word in another language. Okay, thank you.
Thank you very much for your kind words and for your question. I have encountered this problem in my religion paper because this paper is a multinational study. So of course, reports other than the native speaking countries, English native speaking countries, had to be translated. And my problem was to what extent these translations are really accurate, and if using keywords, these keywords would still capture the tone, the real tone behind the report. So what I can say is this: if you plug into your translated keywords into Diction, for example, or into similar software, then I believe that you will still be able to get scores examining annual reports that are in the domestic language in Indonesian. But what it would be very important to do first is just to run a pilot study and see that the scores that you get do make sense. But I believe exactly because the software does allow you to use your own list of words, and then based on the list of words, the scores are created. So it may be that the software is American, I think, but if you use your own keywords, in your language, in any country's language, then exactly because the scores are based upon these keywords, then I believe that the scores will still be able to be created.
I asked this question because when we send a manuscript to certain journal and then reviewer, when we say that we adopt a certain language from a certain list of words from English, for example, and then the editor or the reviewer questioning, do you believe that these words is accurately reflect in your language? This is the common question when we use a certain word when we talk about the language tone and so on in our paper. So that's why I asked you, it's possible to,
Yeah, I actually got the same question.
Yeah.
Not for the language barrier, of course, but for the words that Diction itself has been using, has embedded into its software. That is why in my paper here, I used also Harvard's inquirers and long run and McDonald's.
McDonald, yeah.
But of course, if you translate this and you are the only expert, yeah, I mean, you can say that no such research will be conducted. Of course not. So if you actually make sure that you use different sets of English words, translated, of course, then you make sure that you capture possible aspects, like using different keywords or sets of keywords. And also, since you are the whole expert, the entire expert, the sole expert,
Yeah.
knowing the right translations, then I don't think that there should be a problem after all.
Okay.
All right.
Yeah.
Okay. Anything else, Prof. Anis?
Yeah, the second one, this also interesting. You argue that pessimistic language, you find that is higher for company with lower earning manipulation, is that right? But when I read another paper, especially then the paper use impression management, they usually adopt optimistic language to hide their bad performance or to hide their bad behavior in manipulating earnings. So what about these issues? Because some article also use different perspectives using more optimistic language to hide their bad behavior.
Yes, that is exactly why in my paper I distinguished conservatism into bad and into good conservatism. Exactly. You see, sometimes it is quite difficult to distinguish between the two if you have them, combined. Whereas we know that the bad conservatism is still conservatism, though, yeah, but it's not proper. This is exactly why I have distinguished conservatism into bad and good conservatism. So, in a sense, there's no, contradiction with the literature. Indeed, firms do tend to show more optimistic disclosures to beautify things and show good prospects.
Yeah.
Therefore, it is earnings manipulation, in other words, or manipulation, in other words, or opportunism, in other words, that drives the way that they write their annual report and the information that they basically disclose. But if you distinguish this into good and bad, you see that the good conservatism is aligned with pessimism. Why? Because they both are driven by or born by the same mother, who is earnings conservatism, the good conservatism, of course.
Thank you.
All right. Anyone else? Just please raise your hand, and you may just ask directly to Prof. Iatridis. Okay, Prof. In your paper, you mentioned that the pessimistic tone also affect the value relevance of accounting information. But in this case, you use the R-square as a measure of the value relevance instead of the Olson model or the Feltham-Olson model or Easton Harris that were usually used. And the use of the R-square, which is based on the regression of the 4-year periods, right? The question is that, is it adequate? Only to use the 4 observations.
You judge based on the R-squared and also on the size of the coefficient and the sign of it. So there are three things that one should basically check. Of course, the R-squared is the first one, definitely yes.
I see.
And then the size of the coefficient itself and the sign. To tell you the truth, value relevance is a very broad topic.
Right.
Absolutely. And this is only one avenue of testing the value relevance. Again, when I sent this paper to the journal, I had no question about that. I mean, no from the reviewers. I mean, exactly because, and that is what I've been always trying to do. Exactly because the papers that I quoted were top class papers published in very reputable journals. Therefore, as soon as you, or as long as you show that what you do is validated or at least justified by the literature, there should be no problem. Of course, Dr. Fuad, there are many other avenues, absolutely. But this paper did not focus on value relevance specifically. So I actually got one, stream of the literature that used the R squared, the sign and the size of the coefficients, of the respective coefficients, of course. And then I, move on to another topic. But yes, if you studied only the value of relevance, then one should have dug a lot deeper, absolutely. In alternative models, in alternative ways of testing this.
I see, right. And one last question from my side, and perhaps the audience may also have some follow-up questions. And both your papers do not test the sample selection bias. And now let's get back to your previous paper regarding the, regarding the corporate philanthropy or the corporate giving, and perhaps may I also argue that the corporate philanthropy was also conducted only to some clustered firms only. They have certain attributes that allow them to engage in the charitable activities. And did you test for the sample selection bias, Josh?
I should be honest. When this is not documented in the papers, in none of the two papers, I only did a short, not an extensive, I should confess this, only a short pilot study, not study, I should better say test, using descriptive statistics and checking the distribution of the companies using giving, with corporate giving, for example, just to see to what extent my entire sample follows, or to what extent certain firms are basically irrelevant or not so closely anyway linked to the main theme of my study. So I was basically happy with the distributions, and I did not take any action except from removing certain firms that were showing immaterial corporate giving, for example. Here with the reporting tone, things were different because all firms disclose show their report. They all have more or less pessimistic or optimistic words. So it was more straightforward for me in this paper. But I have not done anything more than just that, basically, just by looking at the distributions beforehand, before starting with all this stuff.
All right. Thank you very much, Prof. Is there any question? I know that you guys are tired, and Prof. Iatridis is also tired because he already spent more than 2.5 hours for this. Okay, any last question? All right. No? Okay, otherwise, thank you very much, Josh. Very insightful presentation, very flourishing discussion, and I do believe that the students, particularly our PhD students, really that took the benefits from your presentations. And we really wish that you can spend some time here in Indonesia, and hopefully that you can visit us, not using the Zoom or online platform, but perhaps Prof. Anis, we can invite Josh to visit Undip, right? There are many beautiful places. All right. Thank you very much, Josh. Mbak Lina,
Dr. Fuad, thank you very
sekarang
much.
Mbak Lina, silakan.
Thank you, Josh.
Thank you, Prof. Thank you,
very
Josh.
much
Thank you, Prof.
for your kind invitation and for your patience and attention.
Yeah.
Let me wish you all the very best. God bless, and especially to our doctoral students, all the very best with their thesis and their research and their career.
All right.
Thank you very much.
Thank you.
Thank you very much. Thank you very much, Josh. All right. We'll keep you in touch. Thank you.
Take care. Thank you very much. Bye.
That was the scientific oration delivered by Professor George Iatridis.
Right.
Thank you. Thank you so much, Professor, for the meaningful lecture. Your lecture will be very beneficial for us. Respected audience, before we close the event, we would like to invite you to an online photo session. To all audience, please turn your camera on so our operator can capture all of us. We wait for all the audience to be ready. Yep, okay. I will let me count. And 1, 2, 3. One more time. Yep. Just a minute. Okay. 1, 2, 3. Thank you. Respected audience, we have arrived at the end of the event, and we hope you have been enjoying yourself at this event so far. Thank you so much for the amazing enthusiasm and participation. Wassalamualaikum warahmatullahi wabarakatuh.
Okay, thank you, George.
Thank you,
very
Josh.
much. All the very best. Thank you.
All right, you too. Thank you very much, Josh.
Okay,
Bye-bye.
bye.
Oke, Prof. Anies, makasih.
Ya, sama-sama.
Nah.
Terima kasih yang lain yang sudah hadir
Ya.
di kuliah hari ini.
Ya.